If you're a gold bug, you've had a tough decade. When it hit its peak of $1,900 an ounce in 2011, we were experiencing the Arab Spring. The Greek debt crisis was kicking off, and Osama bin Laden breathed his last. Since then, it's been a steady downward trend, mixed with a lot of horizontal drifting in a range. But the same uncertainties that are driving some investors into negative yielding government bonds are sending others back to the yellow metal. I mean, zero yield is higher than a negative yield, and you don't have to trust a government to stand behind its paper. And that renewed enthusiasm has been reflected in the gold price breaking $1,400 an ounce for the first time in 5 years. What's even more interesting is to remove the filter of a strong dollar and look at gold's value in other currencies. You can't accuse the pound of being strong in these days of Brexit uncertainty, which may be why gold is now very close to its all-time sterling peak of £1,178 an ounce. It's already exceeded its all-time high in Australian dollars and is only a few percent shy of that in euros. At a time when shares are going up and bonds are booming, it's hard to divine a reason for gold strengthening in 2019. Maybe it's the escalating tension between America and Iran over its nuclear program. Maybe it's fear of tariffs producing a global trade war. The theory that resonates most strongly with me is that it's the nuanced words from our friends in the central banks that have lit the flame under gold. Is it just me? Or is it not very long since we were all looking at a series of interest rate rises taking us away from a decade of emergency rates and moving to something like a normal price for money? Are a few harsh tweets from Alice in Trumpland enough to kill a sound money policy while it's still in short trousers? Once interest rates head lower, the cost of owning dividendless metal is comparatively lower as well, and the safety of a multi-millennial store of value becomes even more attractive. The bankers and politicians seem to have ruled out any threat of a rise in inflation, regardless of how cheap money is. Have they stopped reading the unemployment figures? You'd have to go back to 1975 to see this level of unemployment in Britain and America. Wages and living standards have been in relative decline ever since, so you have to assume that we're going to see significant wage inflation in the next 5 years. Some central banks have hedged their bets by increasing their own gold holding in the last couple of years, but we're only at the start of renewed investor speculation on the gold price itself. One gold ETF alone had $1.6 billion injected in a single day recently. That's the most since it was established back in 2004. Now, I am not a gold bug or a speculator on the gold price, but I do like an insurance policy against financial crises like hyperinflation and the long overdue next financial crunch. So if you don't already have between 5 and 10% of your portfolio in gold, this might be a good time to lose your virginity. What's the best way to own gold? Call me paranoid, but I don't trust paper ETFs that assure me they're backed by enough physical gold to give me delivery of the metal in a real time of crisis. So as Olivia Newton-John might say, let's get physical. I own Britannia coins, which are 99.9% pure and are treated as currency, so they're exempt from capital gains tax. I also own allocated gold via bullionvault.com in London, Zurich and Singapore. Now, although I haven't tested it, the theory is that the gold is allocated in my name and I could turn up in Singapore tomorrow and take delivery of it. When Boris Johnson fails to deliver Brexit on Halloween and the election brings Jeremy Corbyn into Downing Street, I might just be found in the Far East picking up my golden future. I'll see you next time.